Welcome back to the Time to Grow continuation pattern series. In the last episode, we broke down the rectangle pattern and how to trade it. In this episode, we're moving to another powerful formation, the cup and handle pattern. We'll see how it forms, why it works, and how you can use it to improve your trading decisions. We've saved the cup and handle pattern for the end of this series because there's still debate about whether it's a continuation pattern or a reversal pattern. In my view, the cup and handle can be both. It depends on where it forms on the chart. If it forms during an uptrend, it usually signals a bullish continuation, and if it forms during a downtrend, it can act as a bullish reversal. What matters most is that the breakout is almost always to the upside, a bullish breakout. The pattern has three key elements: the cup, the handle, and the neckline, which acts as resistance. The cup forms after a bearish decline. After that, there's a period of consolidation with smaller, weaker candles. This shows the market is bottoming out. Then, the price starts making higher highs back toward the resistance level. This shape shows bulls slowly taking control from the bears. Visually, it looks like a round bottom bowl. That's your cup. During consolidation, volume should decline toward the middle of the pattern and then rise during the up move. This increase in volume signals stronger buying pressure. How the price reacts at resistance is critical. It reveals whether selling pressure still exists or if buyers are taking control. The cup and handle pattern becomes invalid if you see a sharp sell-off from resistance. That's a clear sign the market isn't ready to break higher. But if the price holds well at resistance, this shows bullish strength. It tells you that buyers are willing to step in even at higher prices. Under the resistance, the handle should form a tight consolidation or a steady buildup. Many traders mistakenly short the market here because they've read that resistance equals selling. That only works when the price hits resistance with strong momentum and is firmly rejected. If the price instead reaches resistance and starts making higher lows or a tight consolidation, that's a warning sign. It means buyers are building strength for a breakout. The handle itself should take the form of a flag or pennant pattern, which is a bullish continuation signal on its own. Also, keep an eye on volume. During the handle's consolidation, it should decline. This drop indicates reduced selling pressure and sets the stage for a breakout. Finally, remember, the handle should always be smaller than the cup. The handle should not drop below the lower half of the cup, and ideally, it should stay in the upper third. The deeper the handle dips, the weaker the breakout potential becomes. Think of the handle as the market's last bearish attempt to push prices down. Once the price breaks above the handle, we expect it to rise. Now let's talk about entry, stop loss, and target criteria. Confirmation of the cup and handle pattern happens when the price breaks out of the tight consolidation in the handle. This is the most aggressive and cheapest entry you can get. However, because there's still resistance overhead, the price can reverse and hit your stop loss. A more balanced approach is to go long when the price breaks above the neckline. This is the second best entry point. If you're conservative, wait for the breakout candle to close above the neckline, then take a long position at the high of that breakout candle or on the very next candle. Keep in mind though, this can sometimes lead to a wider stop loss and smaller position size. If that happens, another option is to wait for the price to pull back or retest the neckline after the breakout. When the price bounces and starts moving upward again, you can plan your entry there. Always confirm the breakout with strong volume and momentum-based indicators. Remember, cups with longer, rounded U-shaped bottoms tend to produce stronger trade signals, while sharp V-shaped bottoms are riskier and less reliable. Now let's answer the most important question. Where should you set your stop loss? Whenever you place a stop loss, follow one golden rule. It must be at a level where, if the market reaches it, your trading setup is invalid. In a cup and handle pattern, the setup becomes invalid when the price breaks and closes below the handle. That's why your stop-loss placement should follow the same logic used for bull flags or bull pennants. However, don't put your stop-loss exactly at the lowest point of the handle. This is where the market often trades for liquidity before reversing. Instead, place it slightly below the handle with a small buffer. For example, 180R to give the trade room to breathe. Now let's talk about exiting your winning trades. The first method is the classic price projection technique. Measure the distance from the bottom of the cup to the neckline, then project that distance upward from the breakout point. That projection gives you your profit target. The second method is to trail your stop loss using moving averages so you can ride bigger trends. In trending markets, the price can stay above a moving average for long periods. As long as the price stays above your chosen moving average, keep trailing your stop loss. Exit only when the price closes below the moving average. The cup and handle also has its opposite, the inverted cup and handle pattern. This is a bearish breakdown pattern. Depending on where it forms on the chart, it can act as either a bearish continuation or a bearish reversal pattern. The inverted cup formation signals weakening demand and buying pressure, which you can validate by using volume indicators. Always confirm with volume before acting on either pattern. The handle should be a tight consolidation in the form of a bear flag or bear pennant with contracting volumes. If the handle goes more than 50% above the cup, it's better not to consider it a valid pattern because enough buying pressure at the neckline support level is still pushing prices up. Now let's talk about entry criteria for the inverted cup and handle. You can initiate a short trade when the price breaks below the consolidation of the handle and closes, or when the price breaks below the neckline. A more conservative entry is to enter below the lows of the breakdown candle, once that candle closes below support. If you miss the initial entry, wait for a pullback or retest at the neckline. When the price reverses downward again, then take the short trade. Stop loss can be placed just above the handle with a small 180R buffer. Target can be set equal to the height of the inverted cup from the neckline to the top of the cup, projected downward from the breakdown point. Another way to ride the entire trend is to use moving averages as a trailing stop-loss method. When the price closes back above your moving average, that's your exit signal. Now, these were all the major continuation patterns explained together in this series. I hope this video helped you clearly understand the logic behind each pattern. If you have any doubt about this continuation series, comment below. I'll clear it. Also, tell me in the comments how you're finding this continuation series so far. If you found it helpful, don't forget to like the video, subscribe to the channel, and press the bell icon. I'll see you in the next episode.